Silvergate, SVB, and Signature, the triple collapse exposing the fragility of our financial system. Three major bank runs had exposed the US's fragile financial system. Silvergate, one of the most promising crypto-focused banks, had collapsed. Following its footsteps, the Silicon Valley Bank faced massive deposit outflows, leading to one of the biggest financial failures in the US since the 2008 financial crisis. Spurred by panic, billions of dollars were also withdrawn from Signature, causing it to crash. This whole incident raised a very important question in everyone's minds. Is our money safe in the bank? What caused these leading banks of America to go through such a dramatic collapse? Was it a one-time deal or the start of a ripple effect impacting even more banks in the US and the economy? Welcome to Gritflix, the channel that gives you high-quality mini-documentaries covering topics about money, power, and business. Don't forget to like and subscribe if you enjoyed today's video. And this is the tech bank run crisis of 2023. Silvergate's early success. Silvergate Bank was one of the most credible banks for blockchain companies that revolutionized the future of crypto firms. In 2022, no one could have expected that Silvergate could ever face such a massive loss considering its deposits were over $6 billion. But it was all short-lived. To understand their downfall, let's take a look at how Silvergate became one of the most successful crypto banks in America. In 2013, Silvergate was an ordinary real estate firm. Later in 2013, its CEO, Alan Lane, invested in Bitcoin as a personal venture. That opened his eyes to the crypto world and he decided to transform the bank into a crypto-focused firm. After going public in 2019, Silvergate never stopped thriving. In 2020, they became one of the central dollars to cryptocurrency interchange points, with its stock price rising by 1,580% thanks to the reliable Silvergate Exchange Network, or SEN. Silvergate ended up receiving some of the biggest crypto clients, including Coinbase, Kraken, and Paxos, which made it bloom alongside the crypto industry. However, the reverse was also true. The crypto decline in 2021 put them in a precarious position. The Silvergate collapse. The bank's problems mainly started due to this guy. Sam Bankman-Fried, the wonder child of crypto, turned into its worst enemy. When FTX collapsed in November 2022, it triggered an earlier bank run of $8.1 billion from Silvergate as clients panicked over the industry's stability. This bank run alone had cost Silvergate a massive $1 billion loss, forcing it to sell assets and bonds to offset the withdrawals, and borrowed $4.3 billion from the Federal Home Loan Bank of San Francisco. Now that the crypto markets were crumbling following FTX's collapse, Silvergate found their deposits and transactions dwindling. Not surprising, since $150 million of the bank's deposits had been held by customers filing for bankruptcy protection in December. They had to lay off 200 employees, or about 40% of their workforce. The curtain was falling on the ailing bank. Fast forward to 2023, news broke that federal investigations were underway to check Silvergate's role with SBF and FTX. While it was unclear if Silvergate had committed any crime, the news alone devastated their credibility. Soon enough, as large crypto exchange clients such as Coinbase, Kraken, and Paxos started moving away from the bank, Silvergate was forced to shut down its network and operations, announcing its closure. Silvergate's heavy bet on the crypto industry went bust, and they had no diversification to fall back on. Unfortunately, Silvergate was only the first domino to fall amidst a brewing financial storm. Rise of the startup bank. The situation at Silicon Valley Bank was similar to that of Silvergate. Customers wanted their deposits back, and the bank didn't have enough cash on hand. The scale of SVB, however, was much bigger than Silvergate. SVB was the 16th largest bank in America that offered loans and banking to several tech venture capitalists. The bank soared high during the COVID-19 pandemic as the crypto and startup scenes were also booming. 2020's tenuous global economy paved the way for the rise of new, agile companies that got major funding from venture capitalists. Since SVBs were well known to the VCs, many of them encouraged these startups to open accounts with SVBs to store their funds. This led to massive growth on SVB's balance sheet. In 2020, SVB only had a total of $60 billion in its deposits. By 2022, that number had grown to $200 billion. More than 300% growth in only 2 years? Well, if you remembered our Adani video, such a massive growth was rather unusual. This massive asset presented both a unique opportunity and a problem for SVB. An opportunity for them to invest these assets and earn more, but where to invest them? You see, normally banks would lend out these assets in the form of loans and earn money from the interest. This was the magic trick from which banks practically created money out of nothing. Unfortunately, their unique clientele of startups made this strategy impossible. Startups weren't yet profitable and tended to burn through their capital. They weren't going to apply for loans from banks. Heck, if they did, they probably won't even qualify as their risk profiles were sky high. So no, SVB couldn't work their magic by offering loans to their customers. This led them to the next best thing: US Treasury bonds and government-backed mortgage securities. These investments were considered low risk and relatively stable, offering a juicy 3.9% return per year. SVB patted themselves on the back for the brilliant move and gave each other bonuses. Unfortunately, this brilliant strategy had a tiny caveat. It'll work as long as the bonds didn't decline in value. The main factor influencing bond prices was the interest rate, which had been kept low between 0.125% and 2.375% by the Fed throughout 2009 to early 2022. Then this happened. Within 1 year, the interest rate grew to 4.375%, the highest it's been in 15 years. The US Treasury bonds that made up the backbone of SVB's investments dropped massively in value. When this video was made, the 10-year Treasury had dropped even further to 3.477%, thanks to Credit Suisse currently facing a similar crisis. SVB was suddenly screwed. Billions of unrealized losses were now carried in their balance sheet. But hey, unrealized losses were exactly that. Unrealized. We're fine, as long as we don't sell off the assets. Then 2023 came, and we're seeing plenty of news about startups failing and layoffs. Many companies were facing liquidity problems and started withdrawing funds from their SVB accounts. Uh-oh, SVB now realized they have to realize those losses or they won't have enough capital for their customers to withdraw. The devastating SVB bank run. On the 8th of March 2023, SVB sold $21 billion in bonds of mostly US Treasuries, $1.8 billion of which were losses. Ouch. SVB announced the next day that they will sell $2.25 billion worth of equities and preferred convertible stocks to make up for these losses. Little did they know this very act would cause their doom. The moment this news broke out, hundreds of startup execs and VC bros shared their disbelief and distrust over the bank's stability and liquidity. This prompted many to share that they planned to withdraw their funds from the bank, causing panic-induced withdrawal chaos. One of them was renowned entrepreneur and VC Peter Thiel. His VC Founders Fund was reported to have informed their portfolio companies to withdraw from SVB. Their role as a major VC in the startup scene might have been a key influence in the incident. Thus, the bank run began. That same day, hundreds of SVB depositors went to their local bank to withdraw their funds. Small business owners, startup CFOs, and VC bros, no matter the sizes of their bank account, all wanted out, causing a long queue in various SVB branches. The police was even called to calm unruly masses to their branch in New York. SVB ended the day with a negative cash balance of $958 million, bringing into light the fragility of the fractional reserve banking system all banks in the US thrived on. Soon after, the Federal Deposit Insurance Corporation, or the FDIC, stepped in and temporarily took over the bank, effectively shutting it down until the situation got under control. The FDIC was an important government institution that insured depositors up to $250,000 if their bank ever collapsed. So depositors with savings below $250,000 would get all of their money back. If they kept more than $250,000 though, they're screwed. Honestly, $250,000 insurance should be enough for most people, considering the sad reality that 56% of Americans struggle to cover an emergency $1,000 expense with savings. Remember though, SVB didn't serve individuals, they served startups, businesses whose lifeblood was in the millions of funding they received. $250,000 insurance won't be enough to cover their deposits. It's one of the reasons for the bank run panic because the depositors knew they would only get covered up to $250,000 if the worst happened. Ironically, this desire to save themselves was what triggered the bank's collapse in the end. Thankfully, the FDIC had since announced that they will cover all depositors of SVB and also Signature, even beyond the $250,000 limit. No joy yet for Silvergate. There's an ongoing debate about whether this move set a risky precedent that, yet again, gave the banks freedom and impunity to take risks at the expense of their depositors, since a bailout was available one way or another. For the current incident, it was not technically a full bailout like in the 2008 financial crisis, but it was still helping the banks cover their asses while the taxpayers bore the brunt since the FDIC budget to cover depositors were collected over many years from taxes. On the other hand, not covering the deposits of startups who banked with SVB would likely damage the already struggling economy and would do nothing to contain the growing distrust for banks and the overall financial system. Already, several more banks were showing problems, such as Signature, Credit Suisse, and First Republic. The financial system was cracking, and a solution was needed ASAP. So the government was stuck between a rock and a hard place. At least this decision would benefit the real victims, the depositors. The good news for SVB was that HSBC Holdings plc was ready to acquire their UK arm for £1. The deal had been sealed and the bank was well underway to be acquired. According to the statement given by the Bank of England, residents of England will not face any transaction issues and all of their money was safe in the bank. Moreover, the institute was still authorized by the UK regulators and staff will still be employed. No taxpayer support was required here. SVB insider trading allegations and bonuses. According to a news report, SVB CEO Greg Becker had sold $3.6 million of shares on February 27th, just 2 weeks before the bank collapsed. This was the last in a 2-year-long sell-off that earned him close to $30 million. Other SVB executives, including CMO Michelle Draper, CFO Daniel Beck, and COO Philip Cox, had also sold off shares worth millions of dollars since 2021. A total of $84 million in shares had been cashed out by these executives over the past 2 years. They knew the party was over and they exited first. Perks of being the top dogs in a US bank, right? Interestingly, on Friday, just a few hours after when Silicon Valley Bank was taken over by the government, SVB paid out annual bonuses to their employees. Good news for the employees, but this was days before the FDIC decided they would cover all depositors despite the $250,000 limit. Were they thinking about the depositors at all? Transparency would be a headache for whoever was dealing with the aftermath. Signature Bank's crypto crisis. Joining these two major bank runs was New York's Signature Bank. The crypto lending bank collapsed suddenly just 2 days after the collapse of SVB. Within a few weeks, America witnessed its third biggest bank failure. This had provoked fear among bank customers that it could be another domino that fell, leading to an economic depression. Signature Bank was founded in 2001 and had mostly been an alternative to bigger banks for business owners. In 2018, the bank seized the opportunity to enter the crypto industry and skyrocketed to become one of the most trusted banks in the crypto world. They offered a full-time crypto payment service and received $16.5 billion in deposits. By the end of 2022, the bank had 40 branches with deposits worth more than $88.59 billion and $110 billion in assets. However, as with Silvergate, the crypto crash and FTX's collapse hit Signature hard. Back in December 2022, when crypto clients made up more than 1/5 of Signature's portfolio, the bank announced that they will reduce their crypto deposits from $8 to $10 billion. In early 2023, the bank had attempted to diversify by taking in $682 million in non-crypto deposits and reducing $1.5 billion in crypto deposits. Despite the financial chaos in the US, Signature Bank assured their investors that they are well diversified and stable. Unfortunately, it wasn't enough. The crash of Signature. Customers who knew Signature was close with crypto feared the bank's stability considering what just happened to SVB and Silvergate. On Friday, Signature Bank too faced a bank run as both crypto and regular clients began to withdraw all their deposits. Larger banks like JP Morgan Chase and Citigroup benefited from their downfall as customers moved their deposits to these banks. No one in the bank forecasted anything until Friday when the bank suddenly collapsed. Following this bank run, bank stocks also dropped on its last trading day. Regulators had taken over the bank to protect the customers and safeguard the US financial system. The FDIC had reported that they would cover all depositors beyond the $250,000 insurance, like with SVB, while conducting a sales process so that the services may go uninterrupted. Federal regulators had since signed a contract with New York Community Bancorp, who was willing to buy out Signature Bank. All 40 branches of the bank will now operate under one of New York's bank subsidiaries called Flagstar Bank. Flagstar Bank will now own all deposits and loans of Signature Bank. That included $38.4 billion in assets and $12.9 billion in loans, with $60 billion loans in receivership for later disposition by the FDIC. All was well for now. On a larger scale, the collapse of these three banks, including Signature Bank, had worried investors even more and was responsible for some major losses in stock market values. This may also result in negative consumer behavior as they will be less trusting of the banks and more cautious to decide which institutions they could trust in the future. What's next? Analyzing the entire situation, the ripple effects of these bank runs had led us to question the future of other banks, considering the rising interest rates and its effect on the economic climate. Would the setbacks of this major financial collapse going to affect other banks, especially considering the Fed increased interest rates yet again by another quarter point when this video was made? Analysts were hopeful that other banks at this point might not become additional victims. For now, these bank runs were limited to only banks related to crypto and tech startup. This situation was rather unusual and limited in scope since these banks were less diversified than usual. Both Silvergate and SVB were heavily focused on the crypto and tech sectors respectively, while Signature Bank also had clients in real estate communities and law firms. On the other hand, other banks were more diversified with involvement in multiple industries. In light of the recent stress tests, it was revealed that all these banks can survive a deep recession with lower unemployment rates. Only time can tell what shift this new wave of banking crises will take. Conclusion: damage control had been done on all three banks at the time this video was made. Both SVB and Signature banks were covered by FDIC insurance and in the process of being acquired. Silvergate was still under process as of this video. We'll see and hope for the best outcome, especially for the bank's depositors. If you enjoyed today's video, don't forget to like and subscribe. Also, check out our video on the Adani Group's largest corporate fraud or on why Taiwan's chip dominance is under threat from China.